G'day and welcome to this week's video. My name's Robert Gowdy from Isolation at Home, and I thought I'd be well worthwhile going through share buybacks. There is the Commonwealth Bank and Woolworths one that you can see on the screen here that are about at the moment, and people need to make decisions on these. So I thought I'd go through and give an explanation of what and why, and then the complex tax implications that affect everyone differently, which makes it more difficult to make a decision on. So, firstly, what are share buybacks? Well, it's where companies are offering to purchase some of its shares from existing shareholders, and the effect of this reduces the total number of shares on issue, and therefore any future profit is spread across less shares, and therefore they can have a positive effect on the amount of profit, earnings per share and dividends per share. There is generally two types, and one is an on-market transaction, and CSL have done them for many years, where they're constantly buying back their own shares. I think that's happened definitely in the US with Apple and also Berkshire Hathaway, and Warren Buffett's business, Berkshire Hathaway, has written extensively about share buybacks, and whilst he's a large shareholder in Apple, Apple have been buying back their shares, and without Warren Buffett buying any more shares in Apple, his percentage ownership has increased over time, because clearly he is a buy and hold investor and hasn't purchased any. Now, with off-market buybacks, they come with significant tax implications, and that's where we're going to spend a fair bit of our time today, given that some of these implications are reasonably complex, and I'll do my best to take you through that. And the rules are essentially the same, whether it's Commonwealth Bank or Woolies. It's the same mentality. I will be giving you the example of the Commonwealth Bank one, but the same rules apply across to the Woolworths one as well. Now, why do companies do this? Well, increasing shareholder returns can be one of them, or generally you've got to have surplus cash to start with. But they've got surplus cash that is really more than what they require. They've got enough for their obviously cash reserves, for research and development, potentially for acquisitions. So it's more than what they actually need. Share buybacks, can be done, and this is something that Warren Buffett's done over the years. That if he feels that his business is, undervalued, it's a great opportunity for him to take his cash and buy more of the business that he knows better than anyone else, which is his own. And due to the Australian tax structure and franking credits, the companies can buy, their shares back at up to a 14% discount to the current share price. So it's really an attractive way to reduce the amount of shares on issue and buy it back as a discount. And again, that adds shareholder value as well. So let's go and have a look at the Commonwealth Bank share buyback. It's a $6 million buyback. I think Woolworths is billion, not million, and Woolworths is a $2 billion buyback. Now, the capital component, and this is where it gets complex, where they start to split up the share offer of a very large fully franked dividend and a smaller capital component. So based on these numbers here and my examples, the capital component stays the same, but of course whatever is above that is seen as a fully franked dividend and comes with a very healthy tax credit. And that's where it becomes quite attractive for people that are in a nil tax environment, either personally or via a superannuation fund. So investors need to tender their shares at a discount between 10 and 14%. As a general rule, we know that these are often oversubscribed and scaled back, so we always put in the largest discount of 14%. So let's look at the numbers, and we're looking at the figures when I did this for our client video to provide their advice. So we're using a share price of $106.56. And so that's our guide. So based on a 14% tender discount, so it essentially means we're selling our shares at 91 and 64. You can see that clearly here. The capital component stays the same at 21.66, and the remaining, which is nearly $70, represents a fully franked dividend. Now, this is where we get, with such a large fully franked dividend, we get essentially a tax credit, a franking credit of $30. So this is extremely attractive for a nil tax environment, such as a pension phase in superannuation, or as a couple that earn well less than $29,000 in taxable income each year. I would recommend that you talk to your tax accountant to make sure that this is beneficial for you. And as I mentioned before, there's a lot of large, big superannuation funds out there that paying very low levels of tax, where clients are in pension mode and they're paying a zero tax rate. So this is where it's very beneficial for them, and therefore we could have, and I do expect, a large scale back. So here's the results, and I will show you our calculator just to give you a look at the different tax rates and how different tax rates substantially affect the outcome. So this is looking at an investor super fund that is paying no tax, and looking at the same figures again. So market price of $106.56. So when you're tendering at the 14% discount, you're actually getting $121.63 back. So it's a substantial benefit for those that are wanting to take advantage to reduce their holding in Commonwealth Bank, or take up the offer the shares, get paid $121 instead of $106. And then if you still want to make sure you have the same amount of shares, you can always go back and buy them. So you can see there's a huge benefit there. But let's go and have a look at, this is our calculator that we use. I won't talk about the capital gains tax outcomes. I'll just cover that there just for fun. But we can see here's our number that we worked off. And what I want to change here is, you can see that there is down the bottom, there's the 121.63, and that's a $15 improvement over the current share price. But that is at a marginal tax rate of 0. So if it's within the accumulation phase of superannuation and it's 15%, essentially makes it line ball. And you can see the figures down here as to the benefit that the buyback provides individual investors. Now, a lot of clients will have a self-managed super fund, and they might have half their money in accumulation and half of it in pension. So in that scenario, so we'll just keep the figures really simple, that you've got a $10 million fund, half of it's in pension, in paying zero tax, half of it's in superannuation accumulation, paying 15% tax. So if we put in 7.5%, that's the midpoint, you can see down here that there is an advantage of $7.58. So that would still be worth doing. The downside to understanding all this, that given that so many people participate in it that are paying in a nil tax environment, either in their superannuation pension or personally, there will be a large scale back, and that's my prediction. It may not happen, but I hope that's a really good overview of share buybacks, and particularly the ones we've got coming up. The Woolworths is the same as these figures as well. So I hope that's a help, and thank you for listening, and we'll speak to you soon. Bye.